Tax Guide and Resources for 2024. Hi everyone, my name is Tan and I'm an independent certified financial planner practitioner at Tan Wealth Management. Today's educational video is a sneak peek of the Tax Guide and Resources for 2024, and a more detailed article is on my website at tanfan.com. 2024 tax rate schedule. There are 7 tax brackets for the 2024 tax year for filing status single, married filing jointly and surviving spouse, head of household, and married filing separately. There are 4 tax brackets for the 2024 tax year for estate and trust. If everything is the same, if the taxable income range increases in the bracket, we will pay less in taxes. If taxable income range decreases in the bracket, we will pay more in taxes because more of our taxable income is subject to the higher tax rate. A tax bracket is a range of income where a specific tax rate applies. Each bracket corresponds to a tax rate where the income falls in that bracket is taxed at that specific tax rate. We are in a progressive tax system where a tax rate increases as our income rise. A marginal tax rate is a percentage of dollar applied to the last dollar of income earned. An effective tax rate is total tax paid divided by total income earned. It is our average tax rate.
For example, 10% tax rate applied to the first $10,000, 20% tax rate applied to the next $20,000, and 30% tax rate applied to the next $30,000. Our taxable income is $60,000. Our marginal tax rate is 30% because that is the rate on the last dollar tax. Our effective tax rate is 22% and it derived from total tax liability of $14,000 divided by taxable income of $60,000. This also illustrates a progressive tax structure where a range of taxable income are being taxed at a specific tax rate. The higher our income, the higher the tax rate on that income. With the estate and trust tax rate for the 2024 tax year, we could be at the 30% tax rate when taxable income is above $15,200. By comparison, the tax rate for single filers on taxable income between $11,601 to $47,150 is 12%. To reach the 30% tax rate for single filers, taxable income needs to be over $609,350. We want to keep this in mind when we are structuring and handling trusts. We really have to know how the money flows from us to the trust to the beneficiary and how it is taxed.
Standing deduction and child tax credit. A standing deduction is a fixed dollar amount normally adjusted for inflation that reduces the income on which we are taxed. We subtract the standing deduction from our adjusted gross income to reduce our taxable income. It is a simpler method to decrease our taxable income, and the deduction amount is determined by the tax filing status. People who are blind or over age 65 receive an extra deduction to help them reduce their taxable income. The child tax credit is per qualifying child. The credit is partial refundable and there is an income phase out. A tax credit is better than a tax deduction because a tax credit is dollar for dollar reductions on the income we are taxed.
Here is a simplified version of understanding the impact of tax deduction versus tax credit. Example 1. Taking a tax deduction. We made $100,000 of earned income. Taking a tax deduction of $10,000, taxable income of $90,000, assuming a flat tax of 20%, $90,000 multiplied by 20% equals $18,000 in tax liability. Example 2. Taking a tax credit. We made $100,000 of earned income. Taxable income of $100,000 because we are not taking any tax deduction. Assuming a flat tax of 20%, $100,000 multiplied by 20% equals $20,000. $20,000 minus a tax credit of $10,000 equal $10,000 of tax liability. This is what I meant by a tax credit is a dollar for dollar reductions on the income taxes we owe. With tax credit, the tax credit can be refundable tax credit or non-refundable tax credit. What is the difference between a refundable tax credit and a non-refundable tax credit? We benefit more from refundable tax credits because they provide a potential for a cash refund. Here is an example of a refundable versus non-refundable tax credit. Refundable tax credit. We have a $1,000 tax liability. We claim a $3,000 refundable tax credit. The $3,000 offset the $1,000 tax liability and we get a check for $2,000. Non-refundable tax credit. We have a $1,000 tax liability. We claim a $3,000 non-refundable tax credit. The $3,000 offset the $1,000 tax liability, and we do not get a check for the excess amount of $2,000 because the non-refundable tax credit will only offset up to our tax liability.
Tax rates on long-term capital gains and qualifying dividends. There are 3 tax brackets in long-term capital gains and qualifying dividends. Net long-term capital gains are taxed at graduate tax rates with other exceptions. Net short-term capital gains are taxed at graduate ordinary income tax rates. Net long-term capital gains are taxed at graduate long-term tax rates. If we have $1 million in long-term capital gains, we will be subject to all 3 capital gains tax rates. Qualifying dividends are taxed at capital gains tax rates. Non-qualified dividends or ordinary dividends are taxed at ordinary income tax rate. The 3.8% net investment income tax. The net investment income tax applies at a rate of 3.8% to certain net investment income of individual, estate, and trust that have income above the statutory threshold amount. The 3.8% net investment income tax applies on the lesser of the taxpayer net investment income or the amount that exceeds the taxpayer modified adjusted gross income as shown on the tax guide. These threshold amounts are not indexed for inflation. Some strategies could avoid the net investment income tax is to keep our modified adjusted gross income below the statutory threshold. Avoid increasing taxable income when we don't have to. Increase net investment expenses. Contribute to account that can reduce our income. Installment sale. Sell investment at a loss to offset investment gain. Defer capital gain. Use Section 1031 like-kind exchange. Use Section 1031 exchange. For more details on the net investment income tax, check out this video. Tax planning tip and insight. We want to make sure we are getting every tax deduction and tax credit we are entitled to because we work hard for our money. We want to understand our tax bracket. Maximize retirement contribution. Take advantage of tax credit. Utilize tax deductions. Consider taking itemized deduction if itemized deduction is higher than taking the standard deduction. Invest and withdraw tax efficiently. Capitalize on tax loss harvesting and tax gain harvesting when it is our advantage. Utilize tax advantage account, HSA, FSA, 529 plan, etc. and control our tax liability through bracket management. When I do financial planning for my clients, I use a tax software to run scenario analysis because most of the decisions we make will have some sort of tax implications. Each layer of complexity heightens the risk of error, thus sometimes simple is best. Please note that this material is for educational use only. Tax law are written in pencil. They can always be rewritten. Tax law are complex. There are exceptions to the rules, and it is constantly changing, so don't do it alone. Be sure to talk to a qualified professional before making an informed decision. I hope you enjoyed this video and thank you for watching. Until next time, this is Tan, your trusted advisor.